How's everyone doing? Good afternoon. It's Friday, nearly 4 p.m. Eastern time. Hope everyone is enjoying the springtime. We've had another streak in the markets, 5 up days in a row. Not too long ago, we had 10 up days in a row in the S&P. Then we had a minor 2-day breather, and we're back. It's really incredible to see this. And, taking a step back, I do think we have a performance chase here. You've got an incredible amount of capital that's offsides and wrong way positioned, and they need to get back in the market, and they're not getting opportunities. The market's denying them entry. It's a lockout rally. A lockout rally is a rally that just goes up and doesn't drop to get people in. And what happens on those drops is you have a lot of short activity, and those shorts are covering. So you see small caps, which are heavily shorted by hedge funds, doing well today, for example. It is really quite something. If you're paying attention to the market, there's a lot of dynamics that are happening in the space, right? It's an animal spirits rally too. Those are always fun, right? So I wanted to spend the next 40 minutes talking about the recent hedge fund 13Fs. Every quarter, my team and I pour through dozens of hedge funds filings. We look at their top positions, their new positions, what they're selling. We look at thematically what they're buying. We focus mostly on good funds, although I like to make fun of the really bad funds and terrible sovereign wealth funds like Saudi Arabia. It's just fun to see what they're doing, so you don't do that. So we'll start that today. You can really spend a lot of time doing this. So maybe we'll do another session next week too. I'll also tell you what we actually bought, or maybe what we own that we agree with. So I'll tell you where we're placing our bets. And through this, we can even share some of the tools we're using to research these names quickly, because investing is about looking at a lot of frogs and saying no and moving on to the next one quickly. The more you do this, the more names you've seen before, which helps. So you have a kind of a point of view, and you can see what's changed, and you start to see how managers are adjusting their positions and their themes too. So quite a few observations. By the way, on Sunday, we'll release our 13F tracker in the Lumida newsletter. You'll see it on the Lumida Wealth Telegram. So this is what it is. I'm sharing my screen. You can see different managers organized by strategy type here on the left. And then going across the top, you can see top positions and new positions and what they're selling. And then we color code some common themes and names. So you can see patterns. For example, Meta is a top position across hedge funds, actually one of our favorite names as well. NVIDIA is a number 2 holding. Tesla is nowhere to be found near the top, but I wouldn't bet against Tesla right now during this big short squeeze. But it is what it is, right? You gotta kind of acknowledge the reality you're in. I think Jim Chanos is committing self-violence in shorting MicroStrategy and shorting Tesla now. It's really not a good idea. So let's go through a few funds here. I'll talk about their kind of high-level changes, and then we'll deep dive on some of my favorites and spot check a few others. I always like taking a look at what Druckenmiller's up to. I like taking a look at what Point72 is doing. I like taking a look at what my friends, the quants, are doing. There's some common themes there as well. All right. So, Berkshire, very dry, really nothing new here. They've been reducing their position in Bank of America. Okay, they've been selling off Apple. Not much going on there. Baupost, that's Seth Klarman. I will call out Liberty. We own this name. Liberty is a European-based telco company. Telco is one of these industries that's in decline with cable, but at a certain valuation, free cash flow and buyback, it gets pretty interesting. This business, $3.5 billion market cap, and their buyback yield is 16%. It's very interesting. It's like, why would you own bonds when Liberty Global exists? I'm not sure. Not sure why would you own bonds when a business like this exists. There are quite a few businesses like that, by the way. that you can find in equity markets. So it's kind of near the lows, how we see it here. I'd expect some mean reversion there just from buybacks. So back to the spreadsheet here. Some other ones to call out. Sailing Stone's an interesting one to look at. They're an energy specialist. I won't spend much time there. For natural gas ideas, there are some things worth looking at. Howard Marks, obviously a very well-known hedge fund manager. His top position remains TRMD. There's quite a few comps for TRMD out there as well. We look at this business from time to time. It's been in a bear market. They have it's a fleet of product tankers. We used to own some tankers last year. We also owned tankers at the turn of the year with the tax loss harvesting. They were just so oversold that you have this tax loss harvesting phenomena where immediately after December 31st, these things can start to work. We don't own them now, but they are interesting, especially if Russia can start shipping oil again, for example, to international parties, right? But I think there are easier opportunities out there, but it's an interesting idea. I mean, I think you really have to do some homework and understand the dynamics of that category, though. That's what makes it a little bit challenging. Jeremy Grantham, kind of perma-bear. I always find it funny how his top positions are Mag 7 stocks. He complains about the valuation of the stock market, and he loves holding Mag 7 stocks. Can't blame him. Those are some of the best businesses in the world. In his defense, he'd say, hey, I have less weight in Mag 7 versus the S&P. That's true. So he's owning these businesses, but he has less allocation to them relative to others. Tiger and Co. 2, I don't want to spend too much time on these, just kind of uninspired, I would say. I don't really learn too much from their holdings. They like Meta. Lone Pine Capital, I like Steve Mandel, one of the original Tiger Cubs. Meta, another top holding and a new holding for them. They sold LPLA. Actually, we used to own LPLA too. We sold that recently. They sold Vistra and Philip Morris. We also saw other institutions selling Philip Morris. I talked about Philip Morris 2 quarters ago. We saw it in Druck's 13F filings. It's done really well since then. Double-digit return. But Druck is also starting to reduce his holdings in Philip Morris somewhat. Now that's a multi-quarter exercise, so it doesn't mean they're going to be out necessarily, tomorrow. So just bear that in mind. They're slower moving oil tankers. Let's see what else. Seth Klarman from Baupost Group, he also picked up Elevance. Elevance is a Medicare Advantage insurer. They're a competitor of United Health. They've got former executives from United Health. I like Elevance too. I think it makes sense. I think old Medicare Advantage is really cheap and sold out. We bombed out. United Health is just so darn cheap, right? I bought that a day early on Monday, like at 3:50 p.m. There were some fraud reports in Bloomberg. I said, all right. The news in United Health is so bad. I mean, it is just, let me tell you how bad the news is in United Health. After I tell you this, you're going to say, why'd you buy it? Funny thing is, up 5% today. I think the bottom, there's good evidence the bottom's in. But this is so much negative news. They have the accusations of fraud and overbilling. That's one. The CEO stepped down. That's 2. Earnings guidance was cut. That's 3. And insurance companies are public enemy number 1. It's so easy to hate an insurance company if you're a politician. Who doesn't hate an insurance company? System's broken. I agree, system is broken, sure. But we did pick up United Health and also some other insurance companies too. Healthcare, these are acyclical businesses. So, should there become any economic weakness, these will do well. You're getting paid ultimately by the U.S. government or some large corporates. I did look at Larry Robbins' 13F because Larry runs Glenview. They're a smart healthcare-focused fund. Now, obviously, these filings came out in March, end of March. So before the last 2.5 months. So you get to see where their convictions are. You can see what they kept wanting to hold through the correction before Liberation Day, at least the first half of the correction. But in the case of Glenview, their top position is CVS. We sold out of our CVS. Now he owns 20%. This portfolio is in CVS. He bought too high though. Bought too high. He likes Teva. Druck has a big position in Teva as well. He's selling down the position in Cigna, but there wasn't United Health popping up here. So I didn't take away much from his 13F. He did pick up some of these airlines, United Airlines, and kind of straying away from healthcare. Healthcare really got cheap in the last few weeks, though. That might be why. This is supposed to be a healthcare focused fund. He did pick up Oscar. Look at that in the last quarter. Funny thing about Oscar is it's a Twitter animal spirit concept, right? It's a startup that went public. They have a lot of cash on the balance sheet. They're going from negative EPS to positive EPS. A lot of people talking about it now. So that's Oscar. I think this is an interesting idea if you can get a decent entry on it, actually. So, but it's not a conventional healthcare name. What else? One of the funny things we noticed too is Millennium. Renaissance. Let me take a look at what Renaissance is doing here. And we noticed this last quarter as well. Renaissance is buying high momentum names. A lot of quants like high momentum. I like high momentum as well, but there are other strategies too. And if you look at some of his holdings, the holdings include Palantir, Robinhood, Reddit's in here somewhere. There's Reddit. These small positions, but still nonetheless. HIMS. These are Twitter stocks. I have no doubt that hedge funds like Renaissance and Millennium have bots that are scouring for ideas on Twitter. They have more than that, though. They have to look for other criteria and other screens because there are a lot of stocks on Twitter. But, social media has transformed investing. There's no doubt about it. You have to incorporate that. We also picked up Robinhood a couple weeks ago, by the way. It's an institutional name, it's a retail name, it's a social media name, and they are taking share and disrupting legacy players like Charles Schwab. So I think it's a little pricey now, though. I wouldn't want to own it here. I wouldn't want to buy it here. But I did think it was worth pointing out. And the reason I say that is because, when you go through, say, the CFA curriculum or Columbia Business School or Harvard Business School, and they teach you investing, they don't teach you to buy Palantir. They don't teach you to buy Palantir at the current valuation. So it's like, would you rather be right or would you rather make money? That's, I think when it comes to those names, it's really about understanding momentum and when momentum is working, when momentum is not working. I think they're really trading stocks. I don't think they're buy and hold for a long time investments. That's my quick kind of take on that. So Whale Rock, I like looking at Whale Rock. I think they're thoughtful tech investors as well. I didn't walk away with a new idea per se, but I was kind of pleasantly surprised to see that some of the top holdings were CLS and App11. Those were some of our favorite names, actually, although I think there are other alternatives out there now that might be better, like Flextronics. I prefer the CLS, Celestica. Celestica is a Canadian company, by the way. There's App11. The rest, these are names we've seen before. I'm not sure that any really popped out for me as a kind of a novel idea, but they're leading with Celestica and App11. How about that? Let's go to Bill Ackman. I'm not actually a big fan of Bill Ackman. He's really overrated, although he's done some great buys from time to time, especially coming out of the 2008 crisis. So he picked up Uber. Okay, not a bad idea. He did pick up Hertz. That set up the price of Hertz up massively, but he only bought a 50 bips position for his portfolio. He really undersized this. And this is a common theme that I see as well, is that you have managers undersizing their best ideas. He had a 0.5% position in Hertz. It went from, after he announced it, it cost a big lift in that name, went from $4 to $8. What if he had bought 3% instead of 0.5% of his portfolio? Now, that'd be a much larger portion of the market cap. Yes, there'd be slippage, there'd be some impact, but still, fine. You pay 5% to get into your position, but that's a lot of upside there. But this is a common theme. Here's another example: CoreWeave. Brad Gerstner picked up CoreWeave from Altimeter. And he had announced that on CNBC. I was very curious to see, well, how much did he actually pick up? And it wasn't that much. It was not that much. It's a 2.5% position in CoreWeave. He also picked up Robinhood, Alibaba, some other names in China. But not a large position, right? I think that's an example of an idea that was just undersized, a new idea that's just undersized, because it's safer to stick with larger names like Meta and NVIDIA. So that's something I've been thinking about, is like, hey, just the role of position sizing, which is the hardest problem. It really is the hardest problem in investing. But I think overweighting names that people ordinarily put on the tails is probably something to consider more of. Let's see. Some other names to take a look at. I like looking at David Tepper. He's an original thinker. Obviously, he has a big bet around China. We can see what he did during the tariff tantrum. I'm going to share my screen again. And you can see he cut a lot of his positions in China and really just kind of reduced risk overall into this drawdown. Okay. So into this market correction, he cut Alibaba and PDD, still maintained a position, but just a lower exposure. He increased to Meta and Google, so rotated into Mag 7. I think that's a really smart idea, actually. Those are great businesses. If they're on sale, you're supposed to buy them. We bought Google is now our largest position. When it dropped, it dropped 9.5% the last week on a Tuesday. We bought that and brought that up to a 10% position, which is a significant overweight for us. That's a no-brainer. The stock had dropped when an executive from OpenAI was talking about how they might be competing with some of their AI firms to play a role in Apple's search experience for users. So the stock dropped 10%, overreaction. What else? So it looks like he picked up Uber as well. Now, mind you, these purchases are done, and we don't know what they're doing next. So, I don't think it necessarily means you chase these ideas that you're seeing pop up. This is not a popularity contest. You want to find emerging ideas that are less well known. At least that's how I like to approach this. So, shall we go take a look at what Druck is doing? Of course, yes, we should. Druckenmiller, I like to point out when I do these analyses that he has dozens and dozens of holdings, and he's never lost money in the market. Oh, he lost that 1 year, right? But the point is that diversification isn't an impediment. He has an analyst team. They cover a lot of securities. They have a couple different themes. He's got diversification, but he has an edge in all of the themes and all the names. At least that's what they believe. That can work. I think that's the right way to do it, in fact. That's what Citadel does. That's what Millennium does. That's what Renaissance does. They have dozens and dozens of positions. They believe they have an edge on each one. Point72 does that as well, right? So the idea that you need to concentrate to create wealth is flawed. Yes, concentration can make it easier if you made a good decision, but it can go the other way as well. So let's take a look. So some of the things that popped out for me, one, he's starting to reduce his exposure to Argentina. Now, if you remember, in November of last year, we highlighted how he was making bets around these Argentinian banks. With the election of Milei, he made a big bet with Argentina at the index fund level, and he's kind of moved from the index fund position to betting on banks and also like natural gas companies in Argentina. He's trying to trim back on that. I think that makes sense too, actually. We've been doing the same. And the reason why is there are UK banks that are cheaper and also growing earnings growth. And there's more stability in the United Kingdom with a more stable currency than Argentina. So why wouldn't I own UK banks or German banks? These are banks at like 7 to 8 times PE ratios with 7% buybacks and earnings growth and momentum. Some of those banks are up 50, 60, 70% in 1 year. You wouldn't guess that with a bank, right? But that's the case. So if I compare an Argentinian bank to a UK bank or a German bank, I'd rather go in that direction towards the European banks. I'm not a big fan of Europe more generally, by the way, outside of those ideas. So maybe a handful of names here and there, like Shell. But what else? He picked up TSM. I like that idea a lot. Tech has really run up quite a bit. QQQ has run up quite a bit. Meta's now approaching expensive levels again. If you look at the forward PE ratios, I'll share my screen and show what I'm talking about. So we reduced our exposure on Meta. Love the name. Just look, this is Meta's forward PE. It got to this elevated level here, went nuts post Trump inauguration around there, and usually it kind of stalls out or pulls back or the upside's limited. That's called a valuation-based sell decision, right? But let me show you a couple others real quick while we're here, and then I'll show you Taiwan Semiconductor. This is Netflix. It's on the higher end of the valuation range. Obviously, it's some valuation compression here. But let's check out Apple real quick. This has been compressing in value as earnings growth has come down. But look at TSM. This is still relatively cheap. It still has room to go. It's like 16 times forward earnings. 15 is cheap. 15 is a bargain. 16 is you're up 8% from that. It's not bad. All right. It's not a reverse sear tenderloin steak, but it's a New York strip. It's not bad. I used to cook steak in the summertime grilling. Then I had to cut back a lot because my lipid levels went too high. So now I switched to ice cream, of course. My kids watermelon. So throw out one vice, bring in another one. No, kidding too. Garbanzo beans are really helpful and sardines and avocados. So trying to dial that up for my lunch. But look at this. It's a decent valuation, yeah? It's linked to the semiconductor theme, 20% year-over-year revenue growth. I think you should really call Mag 7 Mag 8, and TSM should be part of it. This is one of those obvious statements I think people look back on in a year from now, right? Obviously, it's a hot stock last year, got overcrowded. A lot of that crowding's worked itself off. So here's some other funds that picked up TSM, smaller managers and so forth, which is fine. I think you can find alpha in the smaller managers. Let's go back to Druckenmiller. I got about 10 minutes, and we're headed to upstate New York. Excited. My birthday's tomorrow. So I'm going to drop my kids off with their grandparents. We're going to hang out. That's the game plan. As best as I can, go swimming. Get some time back with my wife. That should be fun. So let's see. Other observations from Druckenmiller. He's loading up on Teva Pharmaceutical. It's a name I flagged before. Now he's doing this despite the tariffs. And these guys have international manufacturing facilities. Maybe that helps them mitigate their tariff risk. They specialize also in generics. The valuation is good. It's an interesting name. That's, I think all of healthcare most of healthcare is very cheap. First of all, you're supposed to be buying healthcare now, but 6.7 times forward PE. It's it's set up kind of nicely here, actually, right? Then I look at some of these metrics, and I'm less excited about it. They're paying back their debt, but once they finish paying back their debt, that 15% debt payback yield, which you see there, then they can start buying back shares. So that could be an opportunity. What else is Druck doing today? Another thing Druck does is he likes to own these names with $3 to $10 billion in market cap. And I think he does it because he knows people will look at his 13F and they'll buy the stock. I'm pretty sure that's what it is. Druck is creating his own alpha because he knows. I'll show you the stock right now. Every quarter, this stock goes up after Druck drops his 13F. It's an animal spirit stock. Okay? It's too late. It already ran out. Maybe it pulls back and you buy it again. Or you can chase into it if you want, I suppose. I don't know. I don't have a view on it. I'm not doing that. But it's called Pure Cycle Technology. See, it's up 8%. That's the Druck effect. Druck bought Pure Cycle, so other people bought this company. It happens like clockwork every quarter. Now, when I look into the business, it's an okay business. Not a great, it's not a fantastic. I mean, it's gone really kind of nowhere in 10 years. It does have momentum in 1 year, like 83% return, probably when Druck started buying it, right? But the metrics are okay. It's not a fantastic business. In fact, they're issuing shares. That's like shareholder dilution. They engage in the production of recycled polypropylene. So it's like an ESG play. It's an okay idea, but Druck, he's creating his own luck through his 13Fs. We saw that in the prior quarter when he bought the Argentinian banks and they started lifting again. He also bought, excuse me, he also bought Joby, which is a popular animal spirit stock too, up 3%. Today too, a little bit of the Druck effect there. It really hasn't gone anywhere. This is a classic animal spirits profile, by the way. Like you get these sharp up moves, but then they bleed out. And the sharp up moves are during these very compressed periods of time, usually around Q4, usually around May and June of this year. And then they just kind of bleed out like they have done here, right? This is Joby Aviation, right? Short, furious rallies, and then they just kind of bleed out. That's classic animal spirits, right? So digital assets are like that, right? It's a vertically integrated air mobility company. Their competitor, Archer, was just apparently awarded a contract to go fly people around in LA during some upcoming event. Went up 8%, 9% today on news. So I wasn't terribly impressed with Druck's ideas this quarter. I usually am. He sold airlines in the correction. So he might have said, gee, there's a recession coming. He sold airlines. He may have bought back into them now, actually. I think some of the airlines are interesting where they stand today, like United and Delta. It just comes down to whether you believe there'll be a consumer-led recession or not. And 200,000 jobs created. Top of the month, the initial claims data came in low yesterday. The visa spend year over year is 8%. And the important thing is markets are up. That creates a wealth effect. So people have PTSD and TDS and a lot of things, but they're still spending. Funny comments here, but yeah, I think people are offside. I think the rally can continue through June. Now, how long will it take to unwind all of this wrong way positioning and hundreds of billions of dollars? And the other metric to watch is this decay in the VIX. This is a good clock to take a look at. I think it's one of the more important things if you're watching in the current environment, right? So the VIX, the so-called fear gauge index, it's melting. When it's done melting, then maybe the rally starts to give up steam, right? But you had the peak levels here around April 7th, April 8th, and around Liberation Day. And now we're at 17.23. we're still not at historically low levels. It could still drop a bit more. But the other part of this is the fundamentals, right? The year-over-year earnings growth we saw this past quarter is 12%. Analysts expected 6%. It's 12%. So analysts have to increase their earnings estimates and their price targets, and that allows institutions to buy in. I don't know. We'll see. We got to play by ear. We have to assess. Like, there's so much damage done from this correction. There's so much damage done that we may be surprised. I think you really have to look at 2018 as a comp. Let me do a digression and share that with you. Questions asking, do you top in the summer? I think a pullback in the summer is very reasonable to expect, though. In fact, markets have been respecting seasonality the last 2 years, including this year too. The last week of February has negative seasonality, and that's around when the market tops. So, but I'm sharing my screen here, a chart from end of 2018. Let me pull this up for you here. That's right. Yeah. End of 2018. This would be tariff war 1.0. Okay. We'll go to take a look at how things played out then. As soon as this tool starts cooperating with me, 1 second. So on this screen here, I'll share my screen. What you're going to see is the end of the correction, which had a 19% drawdown in the S&P Q4 2018. That was here. That's December 26th. Okay. The 10-year was at 2.5%. You had a lot of panic. This time we have a different experience with the 10-year because of inflation and less interest in bonds and a weaker dollar. So that dynamic is different. And then you had a rally that went from 24.55 up to 29.50. And that rally took place over the next 4 months, April 30th, at which point you then had another mini correction, right? So if we do the math on that, that's 29.50 divided by 24.50. That's a big rally. That was a 20% rally. Now you've had a 21% rally roughly now already, which is the typical rally you get when you have a VIX spike as well. So you're just to the right of the typical rally you see after a significant correction. So we're like in the middle of the distribution, just to the right of that, meaning we're on the more positive side of recoveries after such corrections. Yeah, I think it could keep going because there's a lot of capital that got flushed out and indices re-rated very, very quickly on the way up. It just takes a marginal buyer and a marginal seller to agree on a price for price to move higher. You don't need everyone in the market to agree to that price. But when that price goes higher and you have benchmark managers, they've got to get invested. So they have to start buying in, right? What happens 3 weeks ago if you say, hey, let's see how next week plays out, next week goes up, and the next week goes up? You got to start buying. So I think that dynamic's at work right now. And the admin is not talking down markets. So Bill Miller, let me talk about what I bought. Bill Miller is a value investor. He is a very well-known value investor from Miller Value Partners. I want to prove to you that value investing does work. I like momentum. I also like value, but I think they're different styles, and it's actually better to just incorporate them. It's not an either or. So Bread Financial, BFH, not BFF, BFH. So this is a name that I think is interesting. Actually, I know the CEO and the CFO of this company. The CEO's name is Ralph Andretta. He was one of the leaders of the American Express consumer lending business, and then he joined Bank of America. He was an executive at Bank of America, in the consumer bank. We work together, and I know CFO Perry Bieberman. I haven't talked to them in years, by the way. It's now like 5, 6, 7 years. I should. They're good people. They're honest people too, but they know one or two things around lending. Management quality is good, but beyond that, the valuation is attractive. It's got a 4P of 7.8, and they've got some buybacks, although I'm not here for the buybacks. Buybacks are interesting. The price free cash flow is 1.4, which is really cheap. And the other thing we saw in their transcript is their DQs were declining even as they're growing the business. That's hard to see in a lender. It's really rare to find that in a lender. Usually if you're a lender, you're growing, you have to compromise on underwriting quality. You have to compete with other lenders. Like, it's very much like the airline business. You're as smart as your dumbest competitor. In the airline business, if you want to fill your seats, you got to meet the marginal price of your competitor. So that's why the airline business is a hard category. Now, they've cleaned up a lot of those issues. There's less competition in the airline business now. There are routes that are owned by certain fleets. They've got membership programs, so there's less price competition that takes place now, right? But I like the EPS growth on bread, 26% next year and the year following. I think that's a neat idea. Let me show you our AI tool real quick. This is how we do these analyses very quickly. And so this tool is getting the public data, and it's analyzing the transcript for me like an analyst would. So I can get a point of view real quick. And so some of the statistics, the loan yield is 27%. Okay, that's like how much they make on their loans. And they talk about their buybacks, and they have positive trends on delinquency. You always want to make sure delinquency is working well, looking good. It is. And they've grown their direct-to-consumer deposits. That's great, because that means they have lower funding costs. Deposit funding is the cheapest source of funding. So I like this idea. I own Innova too, which is a competitor. I like these consumer lenders in general. I've been talking about those names for a while, but they're working. They're great, and they're cheap. They have free cash flow, and they have buybacks, and they have momentum. So when people say you can't make money owning a value stock, I'm not sure what you're talking about. This one's got a 35% return over 1 year. It's better than the S&P 500. All right. So what else? Another name we picked up is Danaher. Now this is the name we've watched for months and months, and we look at it every month and we don't do anything. But finally we did something, and we bought it. So bought it this morning. They design, manufacture, market medical research, industrial products, the United States, China, and the biotech life sciences category. So the business has good metrics. The value, it's a pricier valuation, 29 times price free cash flow. They do have strong earnings growth though. They've got a buyback yield of 5%. And if you look at how this historically prices, that's a key statistic I want to show you. Historically, it's not often this valuation, at least since 2019, right? It was cheaper kind of between 2016 and 2020, but where it is now, it has a good valuation. So there are a couple of funds that picked this up. It's like a healthcare name, so people looking for folks to healthcare. This is one way to do it. Lee Ainsley from Maverick Capital is one. Two Sigma, and Point 72. We saw it on Point 72's 13F actually. It's Point 72's largest holding at a whopping 1.82%. So, that's a big position for Point 72, right? Yeah, so this has like 9% to 20% EPS growth. It's not a bad idea, just given where it is technically is how I look at it. I think the lows are in. I think the lows are behind us is when I look at this. I'll show my chart again. So I'm looking at it from that perspective too. If it wasn't for that, then I may not be interested in it, actually. So we saw the valuation chart earlier. I believe the lows are in around here. While we're at this, by the way, let's look at United Health again. Look what it does. Look at the 6% up today. So there's a tremendous amount of volume here. Everyone buying that stock knew what they were buying. They're strong hands. And you had an up bar today. So yeah, I believe the lows are in around there as well. I think you hold your nose and you wait 1 year. And it's going to be similar to JP Morgan and the banking crisis. That's my expectation. But I have like a 3.5% weight. We increased our weight this morning. We're around 3.5-ish. Mileage rate may vary up or down depending on strategy and account, but it's around that level. What else? Some other names are out there. I will say there are bargains out there. We haven't had bargains in a long time. There are bargains out there. It's good. It's easy to find ideas now, is what I mean. It's easy to find ideas in good businesses, with good valuations and good technicals, and good trends and good themes behind them. So that's a good sign. Here's an example, my last idea for you. This is an insurance company. Insurance companies were a beneficiary of these tariffs because how do you tariff American insurance company? They're not really a loser in that. They gave up some ground. They start to rally again. I mentioned Renaissance, R&R, right, last week. That had a nice 5-day rally, pulled back, and is back to rallying again. This is the classic quality compounder in the mold of Warren Buffett. Classic compounder. This is one you wait 3 to 5 years and it's compounded in the mid-teens each year, something like that, which it has done the last 5 years, right? But the one we bought today, it's a name we've owned in the past, actually, too. We know the business, but this is an insurance company, property and casualty. The 4P is 8.5. Now get this, the 1 year return is 273%. That's called momentum. And some of the funds that own it, you'll see, hey, Renaissance Technologies, Jim Simons, Citadel, Dimitri Balyazny, they're a competitor of Millennium, Dimensional Fund Advisor. These are quants, Jane Street, quants. Quants like momentum. If you can get momentum and value and quality together, that's the trifecta. That makes every quant happy. A quant gets his wings, goes to heaven. So that's what this is. This is like Virtu, same thing, right? VIRTU. I mentioned Virtu before, right? It's the same thing. Very similar, different business, but same idea. You got good valuation, earnings growth, a good trend, market making. That trend's not going away. With the increase in electronic trading, now they're talking about 24/7 trading. Please don't do that to me. We're not going to sleep. We're going to have a live feed 24/7 here. So, what else? I bought BJ's too. That was an interesting one. It's cheaper than Costco. It's some of the properties we liked about it. But those are some of the things that we bought recently, and we're inspired by some of the ideas we saw in the 13F analysis. And one last one, I promise you, Merck. So Merck, now we know why Merck was signed up. Merck was actually one of my year beginning ideas, my top 10 list. It didn't work. Now we know why. So this pharmaceutical, the pharmaceutical regulations and onshoring and cutting prices. So the market knew this. There's no doubt about it. There's insider trading. There's no doubt about it. People are selling off these names. But now that the news is announced, they're starting to rally. Merck was up 1.68% today. We bought some at the close today. And, if it doesn't work, if it drops below 75, I will get out of it. But if it does, then I'll stick with it. It's a way to approach that. But I'll share some quick stats with you here. Merck has been around since the Nifty 50. It's one of the few survivors of the nifty 50 generation of stocks, quality blue chip companies. It's had a record of being in the S&P over decades. And the business has a dividend yield of 4.3%. Shouldn't that be closer to 2.6% in a normal market? What's the implied price if that's the case? The price free cash flow is 11 times. One of the reasons it's sold off, by the way, is because the expiration of their revenue from Keytruda, which is one of their blockbuster drugs, can happen in 3 years. So they're doing M&A, and they've got a couple dozen oncology-related offerings at various clinical stages of trials. This is the nature of pharma, right? So, and the way we kind of stay on top of Merck, I'll go back to my tool again, is our AI tool. We can see the key risks and the bull bear case for the tool. We'll roll this out in a few months, by the way. I'll put the website name here. You can take a look, get on the wait list. But you can see the patent expiries are the main concern. But at this price, I mean, they're growing the sales 21% year over year. The margins have improved. The dividend yield is attractive. It's a good blue chip opportunity to own. So those are some ideas for you. Hopefully you found that helpful. Let me see who else bought Merck. I can share that with you too. So funds that bought Merck, a number of smaller funds. Been picking this name up here this past quarter. All right. Well, anyway, have a great weekend. I'll see you next week. And what else? We're going to do another event in New York, probably in June. We had a terrific event in Midtown, New York this past Tuesday, and met several people from online there. Really thoughtful group showed up. So shout out to Elaine and Ross for attending. Really was great to meet you both in person. Hope to see you both again. But we're looking to build a community. We've got a digital community in our Telegram chat. I post micro commentary there every morning. I rarely talk about it because the vibe there is so good. It's like just diehard people that love markets and macro investing go there. But we're going to build more community through in-person events, hopefully monthly in June. And so I hope to see you if you're in the New York area. Maybe we'll do an event in other parts of the country as well. All right. Be well, folks. Enjoy your weekend now. Take care.